Welcome to Two Quants and a Financial Planner, where we bridge the worlds of investing and financial planning to help investors achieve their long-term goals. Join Matt Ziegler, Jack Forehand, and me, Justin Carbonell, as we cover a wide range of investing and planning topics that impact all of us and discuss how we can apply them in the real world to achieve the best outcomes in our financial lives.
Justin Carbonell and Jack Forehand are principals at Validia Capital Management. Matt Ziegler is managing director at Sunpoint Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital or Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital or Sunpoint Investments.
So Matt, we got an interesting response to our Q&A last week. So we've decided again to do a second Q&A episode this week to cover some of the additional stuff we got in the YouTube comments or via email or also from some of our clients recently.
Yeah, you got to give the people what they want, you know? I think if nothing else here, the circus is inbred of planning and investing podcasts today.
We are all about giving the people what they want. And I'm actually going to enjoy this because there's some very detailed planning stuff in here. So I plan on putting you under the hot lamp here and seeing what you're made of.
So I am not brave enough to do this alone. I started with just me and the old BA2 Plus, but I can't have a Texas instrument for this. I need a Philadelphia instrument for this. I need to call in a lifeline. Can we get Ben Tuscai on the phone? I need to get my director of planning on the case here. Ben, you're here for a reason.
I'm here, and I frequently travel with my calculator. It goes everywhere with me, with my cell phone. So the planning is always done.
So the question is, Matt, there was that guy that went viral on Who Wants to Be a Millionaire, where basically he got to the last round. He phoned a friend, but he just phoned the friend to tell them that he knew the answer and he was going to win $1 million. So the question is, do you know the answer here? And you just phoned Ben so you can let everyone know that you know the answer. And
No, not at all. And not only that, I'll probably be like Googling stuff off to the side in the background. And Ben, I'm guessing you're too young for this, but Jack, I don't know if this was on your wheelhouse. As we're both holding up our calculators, I'm thinking of, did you guys watch MathNet? Is this on your radar?
No.
Like 80s
When
PBS?
was that?
No. This was like this 80s PBS segment. I am going to find a YouTube clip of this and send it to you. They were like detectives, but they like held their calculators like guns. This is as 80s educational programming as you get.
This does not seem like it would have done well, Matt.
It played well at my house. I mean, the Mighty Mouse and I don't know.
Detectives with calculators?
Hong Kong Phooey. It was PBS. It was safe. It was like I said, it's somewhere between Hong Kong Phooey and, Sesame Street. You got to watch detectives with calculators that weren't guns, but sometimes they would hold them like guns. And this was very perplexing to my Adam West Batman brain.
And you're bringing back bad memories of the CFA exam where I had to have like that. I had the other calculator. I forget what it's called now. The one that's the one that's in like landscape mode. But I've moved on from that. It was too tough a period in my life to go back there.
Don't forget those spare batteries, Jack.
That was a big thing.
You bring two calculators to that exam, and I was really tempted to make the age joke there. I wasn't around for the 80s, so you guys could probably enjoy that stuff on your own. Unfortunately, I wasn't alive yet.
I wonder, are they still using those on the CFA exam? Like, do they still use those old calculators? They probably do, right?
They've all been updated. I think actually the BA2 Plus business analyst professional or whatever it says on this calculator app, I think that might be the new preferred. I think I have the updated version of your old landscape mode 1, which
okay.
Can it do anything different? Probably not. I think it's one of those things like when a sports team, this is me begrudgingly commenting on the Phillies for a second, has an atrocious New Jersey just to sell more uniforms.
Yes.
I think Texas Instruments was like, let's blow their minds with vertical. Sure, guys, it's a friggin' calculator and it's not a gun, MathNet. Take that.
I think we're headed to ChatGPT, complete the CFA exam for me. And you just go like have a beer or something. So I think that's what the future holds.
The C in CFA stands for Claude. That's what you're telling me.
Right, exactly.
Well, let's get down to it. Jack, I got Ben here to help me, but you are all alone. Why don't you start us off with this? We had this in the YouTube comments, which are great place. Leave us YouTube comments, even ridiculous ones, as some of you insist on doing. No comments back from me on this one. But on the constructive comments, which some of you seem to do, Jack, tell me why ETFs are more efficient than mutual funds. This is so basic and so important.
Yeah, it is, because in theory, I mean, it's because of the way the rules work, but in theory, they shouldn't be. I mean, they're very similar vehicles. But I think the best thing to do is to talk about how mutual funds work first as a step back. So when mutual funds realize gains in their portfolio, and they usually do that in two different ways. One is they're rebalancing the portfolio and they're selling gaining positions. The other is when people sell the fund. And so when people sell the fund, the mutual fund has to return them their cash and they have to sell part of their portfolio, and some of that portfolio may have gains in there. So what happens with a mutual fund is those gains get passed on to the shareholders. And you'll see, if you own a mutual fund, you'll see capital gains distributions. At the end of the year, everybody hates this, but you end up with these capital gains distributions, and they can be long-term or they can be short-term, but it's money you receive that you have to be taxed on. And so ETFs have gotten rid of that problem. And the way ETFs have gotten rid of that problem is through this mechanism called the create and redeem mechanism. And so what happens is, and I don't want to get too in the weeds here, we used to run an ETF, so I had to go through all of this stuff to figure out like exactly how it works. So on a basic level, what happens with ETFs is when someone buys, a market maker is out there to sell you shares of the ETF, and the market maker holds those shares. And so that market maker can create or destroy those shares whenever they want. And it used to be, when we did it, I think some people do it in 25,000 share increments now. When we did it, it was 50,000 share increments. And so the market maker can basically create 50,000 shares of the ETF. And what they do is they give the fund all the holdings of the fund an equal value of that. So the 50,000 shares and the holdings of the fund, which is all the stocks the fund holds, those are of the same value. There's a tax-free exchange that goes on there. And so on the issue we talked about before with people selling the fund, causing gains distributions for other shareholders, that can't happen. Because when people sell the fund, that custom create and redeem mechanism works behind the scenes. There's a tax-free exchange. There's no taxable implications for the people that remain in the fund. The next level of it, though, is the level that's cool. And active ETFs, actually, when we first started, couldn't even do this second thing, but now they can. This is what's called the custom create and redeem. And so the idea is, instead of having on the transaction before, we had 50,000 shares of the fund on one side, the entire portfolio of the fund on the other, an ETF can mess with that other side, which is the holdings of the fund. So what I give back in exchange for the 50,000 shares, that can be a specific group of holdings. So if I want to rebalance my fund, what I can do is I can take positions that have gains, I can put them in the other, basket, and then I can exchange that. And so what you basically do is you have a create and redeem that kind of happens simultaneously. And what happens is you're basically getting those gaining positions out of the fund, and you're doing it without having to sell the individual holdings. And so that function is basically what allows ETFs to be tax efficient. And so when we ran an ETF, sometimes when we would remove positions from the fund, we would just do straight trades, for instance, like a losing position or something like that. And sometimes we would use these custom create and redeems. And so the fact that you can use these custom create and redeems allows you to effectively, like a well-run ETF that doesn't invest in derivatives or anything like that, just that invests in pure equities, should not have any capital gains distributions. Dividends should be the only thing that gets distributed to you. And that's what makes ETFs behind the scenes more tax efficient.
It's so interesting because on a client level, like for us as allocators, it's such a no-brainer to own ETFs in most of your equity holdings now, because you actually want this structure playing to your advantage. Knowing that you have this control through this process and part of your management vetting to understand how the managers of the funds are going to treat this thing, because there's nothing worse. I mean, Ben, like getting a capital gain distribution in a down year, or having like you did the Roth conversion and you're all the way up to the limit. Horror stories. You got any?
I mean, it's part of the reason that we wait. I mean, in the Roth scenario, is why we wait till the end of the year, because if you own any active funds, we can't know 100% throughout the year what's going to happen. And depending on the manager that you own, you may not even know until December. Some of them just report some of that information very late and can really derail a tax plan. But there's too many horror stories that come to mind, especially when you think about, we're just talking broadly about capital gains, but within each of those are two different segments, short-term capital gains and long-term capital gains, that are taxed differently. So when you receive those from at the fund level and at the personal level, when you make sales, you have to be conscious of what you're doing. So if you're selling a fund to avoid a capital gain, you could actually be incurring a larger penalty of taxes. So it's just some of these things that you have to think about before, choosing the investment vehicle that you're choosing.
It's so weird because it's easy to forget how important, especially we're talking about mutual funds in taxable accounts right now, basically, but just how important taxes are as a component of your return, the money you keep. And it's not saying that all mutual funds are bad or all mutual funds and taxable brokerage accounts are bad. There's reason to use traditional 40 funds at times for certain strategies. It's just the advantages that many ETFs have operating in this space because of these tax advantages, those basis points add up fast.
That's right. And the big horror stories with this are the funds that have massive redemptions.
Right.
So like if you have a fund that has a lot of gains in their portfolio and other people start selling the fund in mass, if you're one of the people left, you get this massive gains distribution. You did nothing, just all these other people sold the fund and you get this massive gains distribution. It's not a frequent thing, but you hear horror stories of that where people didn't realize that was possible. And you never want to be in a situation where the actions of other investors can have all these negative impacts on you. And that is the case in certain mutual funds. So our next topic, this is actually really interesting because I took the CFP exam. I've been getting more involved in planning, but I always come across these scenarios where it's something that makes me think deeply about like what you guys are doing on a regular basis and all the different parts that go into it. And I had someone contact me the other day who basically has made it all the way to retirement and has zero assets in retirement accounts. So nothing in Roths, nothing in traditional IRAs, but it saved up many millions of dollars in taxable accounts. And it got me thinking about like the pros and cons of that relative to having money in retirement accounts. I mean, we'll talk later about like people who are younger and there's probably like a blended strategy that makes the most sense for them. But once you're already there, this is what you have. Like there are some advantages of having a taxable account. Obviously you can withdraw your principal without having to pay tax versus a traditional IRA. There's disadvantages as well though. As my money grows over time, depending on how tax efficient what I invest in is, I'm going to have to realize tax on a regular basis, but it just seems to me like there's a lot of moving parts to this. And so it got me thinking about this issue of when you get to retirement, like if I could have all my assets in one of the three things, like which one is better? Like what are the pros and cons of each one? Like, I mean, I would think off the top of my head, I would want to, if that had to be the situation I was in, I'd want it all in a Roth because I could grow my money tax-free and I could take it out whenever I want tax-free. But relative to the other two, it seems like there's pros and cons. So I want to get your guys' thoughts on that.
I'm thinking of like the Corleone family, like 401k that never exists. It's just like the money just keeps rolling up and piling up in places. And on one hand, it's great if it's all like, and I'm sure whoever this is completely above the line on all the activities. On one hand, it's great because you already paid tax on the money, but then you have other embedded tax problems that start to become. Actually, start here, Ben. Like, what would you say, magic wand scenario? Somebody comes and they're like, actually, Ben, I've saved millions and millions of dollars and they're all entirely in Roth. What would you make of that person? Both the choice to get there and the reality that they're in right now.
I would say, well, how you got there is the important part. If you are just the world's best trader and you invested $7,000 and turned it into $7 million, then I would say you won. You won the game. However, if you saved every year in a Roth, what you're doing is incurring taxes to be able to get to that position. If you're saving millions, the odds are you were making substantial amount of money on the ride up in that Roth IRA, which means you were on the upper side of the tax bracket, which means you are prepaying your taxes in years now where you're potentially in a lower tax bracket. So you lost that tax arbitrage by doing all Roth. Now, we're already past that point. So like we don't have to sit and cry over spilled milk, but because now you're going to live on tax-free income for the rest of your life. However, you're also going to forego a standard deduction. So that's why this balance is important. You get a free standard deduction every year. So that means you could take out $27,000 for a married couple out of a traditional IRA and never pay $1 in taxes, as long as that's your only taxable income. And that's those conversations when you start to get layers and layers deeper into the all Roth. There is a huge crowd out there that talks about only Roth. And that's where those arguments and the stance starts to have cracks in it.
And this is interesting because this is exactly what I was thinking about in terms of the person who has all the money in the taxable account is if this is done properly, they have the standard deduction, they have exemptions, they have the 0% long-term gains rate to use. So I think some people, like if their income basically shuts off, which is going to happen here, and they'll have Social Security at some point, like you can get almost like six figures out of these accounts without incurring any tax, right?
Absolutely. Yeah. So you can actually get, I think the number was posted yesterday. I think you can pull out, if it's only capital gains, long-term capital gains we're talking about, it's $124,000. That's what you can pull out. Now, don't quote me on that number. It's just roughly estimated. And that's, you deduct the state of deduction, and then that's very finely jointly where the 0% capital gains rate goes up to. So that's a really good scenario to be in. You could sell $124,000. For many people, that's sufficient enough to have an adequate lifestyle. And anything above that, maybe then you're paying a 15% gain on. But again, 15% on maybe another $10,000, $20,000, $50,000 is still a great scenario to be in.
Social Security plus that, not a bad scenario. And you got to remember, these all stack. So it's like every source of income you have, or in capital gains and losses get included in this all stacks. But yeah, to your point, Jack, like that's a pretty good starting position to find yourself in.
Yeah. I mean, obviously if you've gotten to a point where you have no money in retirement accounts and your retirement age, you've made some mistakes along the way. I mean, you could have realized a lot of tax savings, especially if you're in the top tax bracket, which this person was. You've made some mistakes along the way, but once you're there, it's not a terrible place to be in, I don't think. And like, I was thinking there's at least an argument that you'd rather have that, say, $5 million like in a taxable account than you would in a traditional IRA. I'm not really sure about that, because as the account builds over time, I mean, I'm going to be taxed on the gains, but like if like you said, I have the ability every year to take some money without tax. Like you could argue I'm in a better position than I would if I had all the money in the traditional IRA.
Certainly more flexibility. And that's the key. That's one of the names of the game later on in life. So flexibility is a premium there. Sure. And again, we can always talk about like the most optimal scenarios over a 30 to 40 year time horizon. Today, looking back, it's like, yeah, hindsight's 2020. However, to look at the tax situation that we just went over capital gains wise, the only other thing that you need to consider is there's likely some ordinary income if you have a diversified portfolio. That's where you start to think about, okay, we have fixed income that's kicking off ordinary income on a $5 to $7 million portfolio. That can start to be substantial. When we look at the interest rates scenario where we are today, that's taxed. That's stacked as well as your capital gains, Social Security. So that starts to, and that's taxed differently. It's ordinary income levels. It's not a bad scenario, but it's just other things that need to be considered there.
Yeah, you're not going to be able to avoid tax, I don't think, with that level of portfolio. Because like you said, there's going to be some ordinary income, which you can use your standard deduction and exemptions against.
Sure.
Social Security is going to be, with that level of income, is going to be 85% taxable, I believe. So once you take Social Security, that piles on as well. And then you've got your long-term gains, you can use. So that there's probably going to be some tax there, I would think.
Absolutely. And the other thing to remember is the key flexibility here is not just like the amount that you're taking out. It's when you take it out. This person that we're talking about could be 50 years old. They have unlimited flexibility. That is the ideal scenario. If this was all in a traditional IRA, there is ways to get it out penalty free, but you have to abide by a couple of rules. And those rules can really dictate how you're distributing the money, when you're distributing the money, how many years you have to distribute until you get to age 59 and a half. So this person, he or she or they don't have to worry about that. They have that flexibility.
Do you guys know, and I asked Claude, and I was unhappy with Claude's answer to this. Do you know when Bill Bangin did his work around the 4% rule, like what did he assume in terms of like what you had, what kind of account the money was coming out of? Do you know anything about that?
So my assumption on memory, which is terrible, but at least as good as Claude, because Claude can't look back as far as when that paper was written. Was it just in a taxable account? I thought that was the part of the assumption.
Yeah, I don't know the answer to that. So we can look it up. But it's interesting because when you think about like rules, like this is why general rules aren't great. Like if you think about general rules, like the 4% rule, well, my safe withdrawal rate, if I have all my money in a Roth, if I have it all in a traditional IRA, if I have it all in a taxable account, those are probably different numbers. Like it's interesting to think about like how that, where the money is plays into when you think about some general rule, like the 4% rule, which we know nobody actually uses in practice.
And a big part of this, is like on the talking about the $5 million person. So you got $5 million that's all in after-tax stuff. It's really friggin' hard to save $5 million. Like we have the data. 99% of Americans are not going to get to $5 million. I think of the old blues guy joke, I may not have $1 million, but I sure have spent $1 million. You might spend 5 million. You're probably not saving 5 million. If you could save 5 million and you paid taxes, I bet you it's some pretty friggin' high tax years where you cursed at the IRS all the way to waiting for that check to eventually be cashed. So financial planning is really all about financial flexibility. It's really all about how can I make sure tomorrow or in 3 years or in 5 years or 30 years, I am going to have flexibility to deal with whatever new policies and new things exist. Whoever the next guy is who says, I'm sure Dave Ramsey is not replacing the 4% rule with his 12% from my fund withdrawal rate. But I am sure that our thinking on things like the 4% rule are going to continue to evolve, if nothing else, because, interest rates and bond returns have this weird smiley now piece in the middle where bonds were zero for so many years. So it's quirky.
I should have asked you about Ramsey's assumptions when he came up with the 12% rule in terms of account location.
This wasn't your friend who
I'm sure he did some detailed research when he came up with that. Yeah, my friend, he is Dave Ramsey. So when we flip this around, so let's just talk about I made an assumption earlier that, if you were talking to someone younger in their 30s or something like that, you probably, as a general rule, this is obviously different for every person, would suggest some sort of money probably in all three of the different types of vehicles. But how do you think through that process? Like, how do you think about, should people usually have money in all three types of things? And what are the main criteria you look at when you determine that?
It's always ideal, right? Again, we just talked about that. And we have a slide that we always talk to clients about, which is your balance sheet summary to show a pie chart. And depending on what type of client, you own a business, you're a W-2 employee, the pie chart's always going to look different. But we have clients that they make $1 million a year. All right, well, you're not going to use a Roth 401k when you make $1 million a year. You're getting hemorrhaged in taxes even further than you already are. Let's at least get a little bit of tax savings when you hit the $23,000 cap if you're under age 50. But once we go past that point, because if your income's high enough, you're always pretty much going to max out 401k. Then we start to think through, where can we then utilize Roth or after-tax savings when we don't really have an option anymore? And that's where a backdoor Roth can help start to bridge some of that gap. And then after that, your retirement options are somewhat limited. Then we're talking about brokerage accounts. Again, for that flexibility. Not everybody wants to work till 65. And depending on what politician you listen to, who knows if retirement age is going to be 65 forever. So that flexibility is where we start to have that conversation, because retirement funds for high income earners are limited. But that pie chart, depending on your income, that's what's going to drive the conversation, income and taxes.
We always frame this in that CCBS, calendar, cash flow, balance sheet. Know those three things, you can put all this stuff together. And a lot of it comes down to, on the cash flow thing, we're looking at money in versus money out. So in this calendar year, what's the money that came in? What's the money go out? Great. You're in $1 million a year. Great. You earned $10,000 this year. Did you pay taxes? Did you not? In what amount? If you saved money, and Jack, to your point, so it goes onto the balance sheet. You put some in traditional, you put some in Roth, you put some in savings. Great job. But now we want to take that calendar and play it way forward, which is part of the idea of this balance sheet exercise, this pie chart that we show clients that Ben was just talking. Or we go, okay, if you continue on this path, here's what that balance sheet ends up looking like later. And the reason we always talk about them together is because, well, later, if you stopped working, if you stopped making $1 million a year, if you went from $10,000 up to $1 million, now you're going back to 10,000 again, you might need, or might be forced, policy, require minimum distribution, stuff like that, to convert from balance sheet back into some form of cash flow in a future calendar year. The more, again, financial flexibility is the name of the game for financial planning. So knowing that in an unknown future environment, this is potentially the pie chart that I'm dealing with of assets. If I need to convert that back into cash flow, because I'm 30 years old, I have no idea what 72 looks like at this point. Here's some ways to think about how much flexibility is that going to afford me under whatever my assumption set is? This like zooming out aspect to put these things into context, it's just hard to do. I mean, like Jack, like, do you ever think about this? I know you think about this, but I think you also know how hard it is to actually step back and have this perspective.
Yeah, no, I do. I mean, I don't think about it as much as you guys. And, I think Ben's point is really important too, in terms of like, this is not an ideal world where you could be like, what is my ideal breakdown between Roth and traditional and taxable? Like there's rules as to how much, especially for high income people, as to how much you can actually get into these things. And going back to my example before, I mean, that was one of the reasons all the money's in taxable is the person I'm talking about was self-employed with like 5 or 6 employees and like, so too much money to contribute to IRAs, too much income. And then looked at like the retirement plans for the company. And if you start those retirement plans, there's all these rules in terms of how much the high income person can be, contributing relative to the other people. And it just was like too much. And so I'm like, forget about it. I'm just going to put it all in these taxable accounts. So like, we don't live in the ideal world. Like we live in a world where you've got to like work through issues like that. And sometimes you end up with all your money in a taxable account, when you retire.
Nobody gets to pick to win the lottery. And nobody gets to pick how to do this stuff. You don't know how it's going to turn out. So you do the best you can. And part of doing the best you can is you spread things out. Or tis the season for going to Lowe's and getting gardening stuff. Like nobody goes like, oh, we're going to get the garden together. And you're like, and we're only going to plant carrots. Like, unless you're a carrot farmer, like you probably want a bunch of different stuff. So when you're thinking about saving, when you're thinking about accumulating things, like, yes, sometimes this stuff is confusing, but if you want flexibility later, treat it like going to Lowe's and getting this or whatever your gardening place of choice is, like getting a diversified basket, which perfect segue, diversified basket. What's up with watered down factor exposure? This is a great question. I love this. Watered down factor exposure versus focused at smaller percentages. So you did the stuff, you got the money into savings, it's on your balance sheet. You've heard about this value investing thing. Do you tilt a little at the index? Do you go all crazy, balls to the wall, complete insane value factor focus? Or do you go, I'm going to have mostly my S&P 500 index funds and whatever else, and then like, I'm going to carve off 10% and go with the high octane value or momentum or whatever. How do you think about this, Jack?
Well, this is a question we get a lot because we run focused factor funds and there's a lot of focused ETFs out there. And the idea is a lot of people, the majority of people shouldn't probably be investing in those things in large percentages because they're very volatile. And as much as investors say, I can stay the course, a lot of them can't. And so I think like as a massive investment, as a huge portion of your portfolio, those are not the greatest things that are out there. But people kind of think there's the decision between I like allocate aggressively to these things or I just don't have them. And so what happens a lot of times is people will not invest in those types of factor funds, but they will invest in like the watered down factor fund offered by the major provider that is, the S&P 500 with the slightest tilt towards value. And they think, well, that's all I can tolerate. So that's what I need to invest in. And what I think people miss sometimes with that is sizing is such an important part of this. Like anything, and I don't want to say anything because I wouldn't recommend like sizing Dogecoin at a small allocation or something like that. But most things that make sense over the long term, like you can deal with the fact that they're more volatile by sizing them and also by looking at how they are correlated with the rest of the things you're doing. And so sometimes these factor ETFs, sometimes the better way to do it is not necessarily to have the watered down factor ETF in the large position. Sometimes the better way to do it is to have the reduced position in the more aggressive factor ETF. And you're actually getting more value exposure for your money that way. Even though sometimes the more aggressive one usually has a higher fee, but you're getting way more octane for that fee. So I think in a lot of cases, that's something people miss is the idea that maybe I can't take the ride of these more aggressive factor funds. And a lot of people can't, but there's ways to use them intelligently, like within a portfolio where you can still use them. And I think in many cases, you get better value that way than you do buying like the watered down index hugging factor fund.
There's so many things where just position sizing solves the problem. And in cases like this, and especially where, because you're likely not going to have a focused factor fund or something like this unless you believe in it. It might be because your allocator or your investor, or the person you hire believes in it, and that's why they're doing it too. But likely you have something that you're like, oh, I get this. I just also get why this might not be a good idea for everything I do. actually getting something that accomplishes what you want it to do, that gives you the exposure, and then understanding how to size it. Like that's most of the battle. And I love what you said, especially on like a fee adjusted basis and everything else too, Jack.
Yeah, it's everything in investing. I mean, it's always like these hard and fast rules usually don't work. It's like you have to think through all the details and all the nuance behind the scenes. And I'm a big believer. I'm a big believer that a lot of people should just index their money. And as much as I think factor tilts will add value over time, for some people, just the ups and downs of that are too much. But I think just saying like, well, I can't take the focused fund, so therefore I shouldn't have it, is not the right way to look at it. I think in general, you want to look broader at that and say, well, what would be the circumstances under which I could fit this into my portfolio, inside of the risk constraints I want to live with. And a lot of times you can, just by sizing them smaller.
Yeah, it's a really interesting conversation, especially when you get into quirky stuff people want to own. All right, another terrible segue. Well, let's get into really quirky stuff. Go ahead, Jack. We got a question. This is a Ben question.
Yeah, well, I know, Matt, with you having billions of dollars in various trusts, you're very concerned about what might be happening going forward here with the tax law, estate planning. Obviously, you've got a lot of things on your mind right now. So I don't want to put you under the stress of having to answer this while you're dealing with those kind of problems.
Listen, here at Matt Shear Hathaway, where we set up a private holding company, you have no 401k or savings. No, yes, please don't put me under the stress. Get that calculator gun ready, Ben, because we've got a question about taxes for you. I hear there's some 2026 tax changes coming, and as the poet philosopher Michael Stipe once said, it's the end of the world as we know it, but I feel fine. Why do you feel fine?
I mean, it is the end of the world. It's the end of the tax world that we've been living in as we know it. So there's a variety of layers to this, just like there is anything. So the estate tax exemption is what we're obviously referring to here. That sunsets at the end of 2025. So in 2026, those numbers will effectively be cut in half. So today, the joint exemption is somewhere in the ballpark of 25 to 26 million. So for many clients or investors, you're not even worried about that. However, once that number goes from 25, 26 million down to 13 or 14 million joint, you start to open up a wider range of investors that are going to fall into this estate tax complication category. And you have to keep in mind, estate tax is not just your investable accounts. It's life insurance payouts, it's your home, maybe rental properties added to investable accounts, cars, other assets, maybe you own a boat or something like that. So,
and things, the value of the business is one people miss a lot of the time.
Huge.
Like if you've got a business, you don't think about that, but if you've got a business that makes a lot of money, and you value that could be a big hit towards estate tax.
It's massive. I mean, we have clients that'll have, a $10 or $12 million business, but they have $2 million of investable assets. And you start to do the math. You're like, today, sure, there's no problem. In just 18 months from today, we have a problem. So, and we can't bank on, I know we're in an election year. We can't bank on politics and legislation to save you. So we have to start to put the plan together ahead of time.
I think it's really interesting too. I want to relate this to the 30-year-old versus the 60-year-old. If you're a 60-year-old, and you've got a landscaping business you've built up for the last, 40 years or something, or a contractor business, or pick whatever stuff we don't think you didn't. Oh, I'm sorry. You're not Mark Zuckerberg. You didn't found Facebook, but you have a successful business, a doctor's practice even. You got this thing that's actually worth something. If you're 60 years old and you've built this thing, this is another asset you need some methodology for valuing or understanding your exit from in now policy and future policy. And it's really, really worth thinking about because how big these tax dollar differentials might be. Likewise, if you're the 30-year-old and you're starting something, and Ben, we have this conversation a lot too. You have no money in taxable savings. There's no money left over for it, but you're building that business, those investments into that personal business. That's part of your balance sheet. If you're building one of these more practical things, again, you're not building a tech startup that's going to go to zero. It's no, I do this job, people give me money, and I have to buy equipment and grow this thing. Similarly, you have to understand all these levers because of the income tax changes and the other stuff that's right around the corner here. This affects everyone who pays taxes.
Absolutely. It's so often it's talked to in our industry about the estate tax. But the other areas that is going to affect more Americans is the standard deduction gets cut in half. We've been living in this beautiful land of, if you're not itemizing, you still have this massive standard deduction that we've got that was doubled. That's going to be cut in half and then obviously adjusted for inflation. Then you have the brackets. The tax bracket's going to revert back to the 2017 era. So most Americans' taxes are likely going upwards, depending on more people will go back to itemizing because you'll have the access to your state local taxes again and real estate taxes via SOL. But these are the things that we have to start thinking about heading into 2026. Should we be adjusting paycheck withholdings? How is that going to impact your cash flow? Back to the CCBS comments that Matt had earlier. So a lot of important layers to be discussing within taxes as well.
And how about the, I think it's called the QBI, the qualified business. Is that going away as well?
That's going, yeah. So that'll be discontinued again. This is all if nothing happens. But so that one for business owners has been such a relief, especially for those that have gone over to maybe an S Corp and they're collecting a wage as well as the business distribution. During this QBI era or qualified business deduction era, you've been able to take more wages and have a larger deduction. You may pay a little bit more in FICA tax, but there's a balancing effect. Now people are going to be, I think probably pushed back to taking a larger business distribution because of the taxation of benefits there. So yeah, there's a list of changes that are coming.
And is the time frame on the income tax stuff the same as the estate tax stuff?
It's everything is set for 12/31/2025.
And how do you guys, this is something I always think about, like how do you guys think about like potential tax changes? Because we don't know for sure. I mean, it seems in this case, I don't want to say it's likely because we don't know who's going to win the election. So,
Sure.
The election is kind of a toss up at this point. Like if Trump were to win the election, the odds are obviously much stronger that this stuff continues. If Biden wins the election, I think he said there's no chance that it continues. I mean, unless they overrode a veto or something like that, which doesn't seem like that's going to happen. So like, how do you guys think about that when you plan for people? Because you have to plan for this unknown scenario where you just don't know what's going to happen, but like certain things could happen and have major negative consequences for somebody.
Well, first and foremost, anything a politician says is a promise that we know they'll keep. Read my lips.
No new taxes.
Yeah.
I remember that still. I'm old enough to remember that.
I won't go to a younger example for Ben. I'm going to spare everybody any atrocious modern last 5-year trauma of anything.
I don't think Ben needs too many examples, probably based on where we are right now. If politicians saying thing and not being true. I think he's seeing those pretty much on a daily basis at this point.
It's a glorified thing. I think this is one of those, a financial plan as not a static, but a dynamic document that you have to map these things out forward is what, I mean, this is what we've built a business just on this concept of being, since you don't know what happens yet, not only do you not know when the next recession or bear market, or the next time your job's going to, all of a sudden you get laid off, or the next time your business goes in the crapper, or the next time you start a business and it goes to the friggin' moon, or you're, example from a couple of years ago where it's like, oh, I dated this guy years ago. He was really into tech programming. He told me to buy this thing called Bitcoin. I heard it's worth a lot. What do I do with this now? Life is weird. So just having a framework for how you think about it that goes from what's on the calendar that matters to me, basic real life stuff. What's the cash flow in a given calendar year under what we know to be true today about tax code and things like that. Then what's the impact on the balance sheet over time? Do I have assets in different places, assets with different tax treatments, whatever else? What would it mean if I ever wanted to take money out of those? If I have this document, I can at least say, based on what we know now, what does this look like? It's no different changing tax code than having like a giant bear market. What's going to happen is if the tax stuff all does change in 2026, the very, very end of 2025, then that means we're just going to take this stuff, we're going to update assumptions, and we're going to go, it's the map in the mall all over again. Just where are we now? This is what we think is in the mall. We think this has been updated. These are the stores that are there. I'm really killing Ben with 80s references in this thing, apparently. What's a feeling? Miserably, what's a mall? Go watch Stranger Things. But the idea of like, you just got to know where you are now on the map and then how you're going to get there. You got to tell the GPS, hit the little button that says, here is where I'm located. Now reroute me to where I'm going from where I'm located. That's the whole point of doing any planning in the first place. Chart that path back out of this thing. Ben, what else do you say when people are like, how much time and energy and effort should I invest in this right now to think about all these 2026 scenarios?
Yeah, projecting out like what might happen. It's always the fringe cases that you probably just want to make sure is like on your radar. Yeah, in the obvious scenario where, okay, income is going up in somebody's career and we know that it's likely that tax code's going to change, maybe we pull forward some taxes to pay it at a lower rate. We would do that in any scenario though, like regardless of what legislation is coming down the pike. Other than that, as far as the estate tax side of this conversation, if somebody is young or in their 40s, we'll say here, and is in a potential estate tax problem, we're already probably talking about this regardless of what happens. Because if you're 40 with $20 million, the odds of you being 60 with $50 million is pretty high. So we already needed to start engaging a client on irrevocable trusts or whatever the strategy is going to be at that point.
Yeah, it seems like it's a balance between like odds and severity to some degree. Like you have to look at what are the odds of something happening, but also like if the severity is really, really bad, even if the odds aren't that high, you've still got to be thinking about it from a planning perspective. If this person's going to suffer a terrible like catastrophe, if certain thing goes through, then you've really got to be thinking about it.
Yeah, you can think about it as like the same way as like when you think about life insurance or insuring anything is, low risk, high severity, low severity, high risk is where do you want to fall on that risk spectrum? And yeah, it's one-off cases. I wouldn't say that there's no like blanket guidance, but these are things that like you probably need to be engaging most clients with.
And it's also, we've talked about this, Matt, on our breaking news podcast. Like it's also important to keep in mind that regardless of which side of the aisle you're on, basically right now, what everybody is proposing has nothing to do with actually solving any kind of problems. Like both candidates are proposing things that are going to get themselves elected right now. Yes. So you have to kind of take it with a grain of salt to some degree. Like they may have this crazy proposal, but they're not creating that proposal like with the help of economists right now. They're creating it with the help of their campaign team, who's going to tell them like, here's how you get elected. And then what we see after the election might be very different.
The only market that really matters to them are the voting markets. And granted, those voting markets are tied back to real markets and things like this, but it's seeing things through that lens is tremendously useful and probably helps to restore just the slimmest shred of sanity. Because if you're taking politicians at trust value on these things, you're probably gonna start imagining a lot of fringe cases that you're gonna be overinsured. You're gonna be that person who buys the crazy life insurance policy to borrow against and never pay tax for the rest of your life. And there's better ways to get scammed out there. Trust me on this one than falling for that. Hey, speaking about totally not a scam, Jack, investing in AI. We just saw NVIDIA earnings. This is clearly the way. Don't invest in anything ever aside from AI, and maybe even let AI to do it for you. What are you seeing in that space in the quant world? Is AI all the way down?
The first thing is like the quant world is like the least applicable to this, which is interesting. Like we can't, as a quant investor, if you ask me to like find you a basket of AI stocks, like there's nothing that works because ultimately the numbers just aren't there on these kind of companies. So you have to be the venture capitalist who actually looks at the business without the quant tools and figures out like what has the most potential. Like what would have told me NVIDIA was going to do this? Like what could I have pulled out of the balance sheet and the income statement? By the way, NVIDIA had like the year before this happened, they had like flat earnings, like not much was going on there. And then suddenly, they start doubling and tripling their earnings. So there was nothing, you had to be a person analyzing the company to do it. So it's interesting because this is like where my skills are the least applicable is in these new cutting edge technologies, because you can't use, at least right now, maybe, with whatever, ChatGPT or something, maybe you can eventually, but right now you can't use these quant tools. But in general, it's a question we get a lot because people want to participate in this kind of stuff. So, you saw the internet back in the late 90s, you got AI now. We know we're at a pretty high level of certainty this stuff's going to change the world. We also know there's going to be companies that come out of this that we're going to be like, why the hell did I not invest in this thing? Like this thing, if I had put all my money in this stock, I would be whatever, sitting on a beach in, wherever the Virgin Islands right now or something like that.
Amazon and pets.com are both amongst us right now. And that is an old reference, but hopefully not too old. But like, there will be the thing that you're like, I've had how many chances to buy Amazon, like in size over the last 20 odd years. And you had a couple of chances to buy pets.com before it completely blew you up. We are living in the AI version of that potentially.
And what's interesting from this perspective, just to show, and no one should obviously ever do this, but just to show the impact of like these big positions like Amazon. You know what was a great portfolio? 50% Amazon, 50% pets.com. That was a tremendous portfolio. In terms of where you went, the returns you got long-term, obviously it's over-concentrated and nobody would actually do it, but it just shows like you can lose all your money in one position in these types of spaces, and the big gainers will make up for it depending on how blended you are across all the other names. And that is the challenge of this. And that's the challenge from a factor investing standpoint. Like if you look at growth investing in general, you'll find two things. One is if I buy a basket of growth stocks, my performance over the long term is horrible. Like O'Shaughnessy showed this in What Works on Wall Street. He looked at like high price to sales stocks. That's a bad portfolio, but within that portfolio will be the best performers in the market typically. So when I look back and I say, these are the companies I should have invested in, they come from the growth, what we call the growth decile, the top 10% of the growth stocks. But if you invested in all those stocks, you would lose money. And that is the challenge of investing in AI. It's the challenge of investing in anything is the big winners will be in there, but most of the companies will be losers. And how do I invest in such a way that I spread my bets so that I get the big winners, but they're not offset by all the other companies? And I don't know the answer to this. It's very challenging. Like we had Quay Nguyen from Research Affiliates on our live stream, and she actually said like the best way to do it is to invest in a basket of AI stocks, which kind of surprised me to some degree because typically investing in a basket of those types of stocks, the ones that don't work out may offset the big winners, but it's just very hard. Like if you're a growth investor and you're an expert in this area and you're an expert in AI and you can pick winners and you can make a 20 stock portfolio that eventually includes the ones that are the huge winners, you're going to do really, really well. The problem is if you're not that, if you're your average investor, like, and you buy the ETF that has all the names associated with AI, like, are those big winners going to offset the ones that don't work out? It's hard to say. And it's why these new technologies are really, really hard to invest in.
It's also interesting because it reminds me of like, this is a version of the market cap weighted argument. Like you have to buy this basket, but then you kind of have to see it out too. And that means letting some stuff fall off and go to zero, but also like committing to letting some of those proverbial winners run. And this is not a risk control conversation when we're asking, how do I invest in these companies profitably? Or is it a risk control conversation? How do you think about that part, Jack?
Yeah, it's interesting. And I was just thinking when you were saying that about like, one of the key points for people to understand is you typically do get these big winners in index funds. That is, so one way you can benefit from AI is you can buy index funds, and whoever it is that wins, obviously if you bought index funds a long time ago, you've benefited from NVIDIA, you've benefited from Amazon. Now you haven't benefited to the degree if you would, put a 20 stock portfolio together with all of them in there. But the question is, if you would put the 20 stock portfolio, would they've even been in there in the first place? Because it's very easy to look back and say, here's Amazon, what it is today. If you look back at what Amazon was, there were periods where it was like, this thing's not going to make it. This thing's a catastrophe. This thing's just a bookseller. There's all kinds of things that where people just doubted Amazon all along the way, and it overcame that. Now there's also a lot of companies like the pets.com where people doubted them along the way, and they were 100% right about doubting them because it completely collapsed. And that is the challenge of this. Like, so there's this continuum from index fund. I'm going to get the benefits of these. I probably won't get them in early stages if I, buy the S&P 500 fund because they won't be in there, but eventually they'll be in there and eventually I'll get the benefit of it. To the other side, which is, I build this concentrated portfolio. And the problem with the concentrated portfolio side is you have to know what you're doing. And the statistics would say, even the professionals are going to have a hard time doing that. Your average investor is going to have a really hard time doing it. So it's this blend. If you're going to invest in this stuff, you want it as part of a basket. The basket might be an index fund that has all of it. The basket might be something a little bit tighter, but it's just, you have to think about, and you've talked about this in other podcasts, Matt, like understanding your edge in investing. And the question for your average investor is, if I'm going to invest in AI, do I have an edge where I think I can do better than just buying an index fund where the AI stocks will eventually be in there? And, for most people, the answer to that is no. For some people, the answer to that is yes. And everybody's got to kind of make that decision on their own.
Choosing where you will express that edge and how you will continue to revisit it over time. Kind of everything here.
I mean, obviously I have a massive edge in AI and I've built a portfolio of 4 to 5 stocks that will be the winners, but not everybody can do what I do, Matt.
Well, some people are just chatting with GPT instead of chatting with the old, what's your middle name, Jack? We need the J what F or
It's M.
oh, there you go. The JMF, Chat JMF, the only place for all your AI investing needs. All right, Ben, I got to bring you back in on this one. This is another one that, like, there's 3 versions of this question that we basically got, but it's so perspective because a lot of it's domain specific. They're all around the challenges of the current housing market. And it's a big part of why you're on this episode here too. Because it's like, if you own a house and it's gone up a lot in value and you're ready to retire and downsize, that's one way to think about the housing market. If you're, hey, I moved a year and a half ago, we want to buy a house at some point, likely in a totally different area. We drug our feet. The housing market's moved up a lot, starting to come back down a little, but just thinking about buying back in. Housing as a buyer and seller. I'm not asking you for an update on the housing market, Ben, but just like, it's friggin' changed a lot. It's expensive. Interest rates are up a ton. If you're selling a house to downsize, what are some of the things you would walk a person through?
I don't want to just go back to the calendar cash flow balance sheet, but that's where I would start. Because this is a big financial decision that you're making. And just because you're downsizing doesn't mean we're going to taking a no mortgage property and going to another no mortgage property. In this scenario, depending on where you're moving to, you may actually be picking up another line of credit by doing this. So considering that at 7.5% today, that's a conversation, especially somebody that's on a fixed income in retirement. So that's a consideration that we'd have to have. For somebody that's younger, this is the most challenging conversation for me because I don't want to say, oh, just wait. Because and the reality is if interest rates drop in the next 18 months, the amount of buyers that are going to re-enter the market because of having, money to be able to borrow with better rates is likely to go up meaningfully. So that means we haven't solved the supply problem because that can't be solved overnight with more houses, but the demand is continuing to creep up. I think houses are probably likely to get more expensive, which nobody wants to hear. That doesn't mean that you should just go buy because there's still other scenarios out there, which is renting. And that's really where I'd say the common conversation goes. And I love debunking the myth, renting is burning money. That is such a fallacy and is very misunderstood.
And why is that? Just say this out loud because I know this is a pervasive myth. It's definitely partly pervasive because of the number of people who are able to buy relatively inexpensive newer homes anytime from like the 50s to like the 80s and saw massive increases as the new home supply kind of constrained and people moved to the suburbs and whatever else. So like, why is renting not such a bad thing? If you're 25 years old and right now you're not positive you have the place where you're going to live and raise a family or something, why is renting, and especially for them, a great idea?
The greatest line here is rent is the most you will pay for your living situation in any month. Your mortgage, if you own a home, is the least that you will pay in any given month. When you can understand that risk spectrum, then you can understand how you make that decision. I own a home my wife and I bought 8 years ago. In the first 18 months, we spent $30,000 on fixing the house. And that's not, oh, we wanted to upgrade the kitchen. Oh, let's do the bath. No, that was like both units, HVAC units, happened to die. Front door had a storm door had issue. It just piles on. There's like so many unfortunate scenarios out there that stuff happens. So that understanding that risk, also understanding how long you plan to be there. If this is your dream home and you have the capital to do it, great, make the purchase. But if you're unsure of what the next 6 to 7 years is, which is the typical window of how long you need to be in a property, before you start to build equity, please eliminate the last 4 years as your example here, and start to really think, okay, I'm not going to be here 6 years from today. The odds of me losing money on this deal. When you factor in property taxes, closing costs, you need to do closing costs twice now because you're buying the property and selling. You need real estate charges as well. Factor all of that in with the upkeep of a house over a 6-year window. See if it makes sense. There's some really good tools out there that can help you understand what maintenance costs are on your property. You don't have that with rent. So you have to start to think through this more than just the American dream and, society's telling me I should own a home. I need to go buy a house. Your home, it is an asset. It is not an investment. And if you call it an investment, it's a really, really crappy investment. The amount of money that you pump into this thing every year for it to appreciate at 3% average, that's not a good investment. I can find you better things to do with your money than that.
In technical terms, I always like to say, whatever can leak will leak.
Yes.
Like, whether that be the ceiling of your house, like with water coming through it, which I've had, like trying to replace like a cartridge on a kitchen sink, like trying to figure out how to do that because it was leaking in the basement and causing flooding. Like basically leaking of all kind will be like that. That would be your life if you buy a house, pretty much.
That's spot on. It's like at 2:30 in the morning when you're like, why do I hear dripping from my ceiling? Like when I went to just go to use the bathroom, like, oh geez, the wax seal broke and my basement has a hole in the ceiling. Like, yeah, if you're renting, that's a phone call. Somebody comes, takes care of that for you and you're done. You own the home. That's your job.
Which is a great piece for like the person renting made an investment in an asset that's maintenance capital intensive and has a framework, ideally their own plan around how they're going to maintain that profitably, which hopefully if you're renting from them is not ignore your call when the AC is out and it's 95 degrees or something. But yeah, there are trade-offs. You got to think about this stuff. I don't want to miss this question. Jack, you're going to start on this one. The pros and cons of direct indexing versus ETFs. I know we have a whole episode on this, but this one seems to keep coming back to us.
Yeah,
what are the pros and cons?
More because direct indexing is becoming much, much more popular. And your average investor is being able to do it more than they could have in the past. And so the question is, you've got these two things. You've got the ETF, which is basically, I don't pay, the taxes reside in the ETF for the most part, like when they're buying and selling. And so let's just start with like an S&P 500 index fund versus an S&P 500 direct indexing strategy. So the ETF, if I buy and hold the ETF, other than like the dividends, I'm pretty much deferring the taxes for a really long period of time. Now with the direct indexing, depending on what happens, I can maybe do a little bit better than that in that I can sell the losing positions on a year by year basis. I can replace them with something that behaves similarly to them. And I can get something very close to the S&P 500's return while realizing these losses. And so the question becomes, which is better? And then the answer is like everything else in investing. It completely depends on the circumstances. I tend to think the ETF is better in most cases, but the two big factors here are one is the tax rate and two is what is the return path of whatever you're investing in. And those are both, the tax rate can be knowable, although we talked before about like it might change in the future. So somebody in California in the highest tax bracket is going to get the most benefit from direct indexing. And like we've had some clients where we've done it for them that are in the highest tax bracket in California and they have greater than a 50% tax rate. They can benefit a lot from direct indexing. And the second question is the return profile. And so what I mean by that is if 2022 is your first year you start doing direct indexing, you've hit a home run because effectively you're losing money in your portfolio. You have a lot of losses to realize. That's tax you're not paying in that specific year. That money can now compound in the future. So in that type of case, high tax bracket in California starting in 2022, direct indexing tends to, will probably do better than the ETF. But in a lot of other cases, people are in lower tax brackets, the returns work differently for the market. It doesn't work out as well. So it really, and the big equalizer here is the fees. So typically you're going to pay a higher fee for a direct indexing strategy than you're going to pay Vanguard for their S&P 500 fund. So over time, eventually when you're realizing these losses in the direct indexing strategy, eventually let's just say it's a simple S&P 500 strategy, eventually there aren't any losers left to sell. After years and years of doing it, you got to think most of the companies are going to be above where you purchase them. There's nothing less to sell. So then what you have is a tracking portfolio of the S&P 500 where you're paying a higher fee. And so the question becomes, those tax benefits I got in the initial years and my ability to compound that money, does it offset the fact that eventually I have this portfolio now and I'm not going to want to sell it because I don't want to realize the taxes and I'm paying a higher fee? And the answer is it's unclear, but I think I used to be a completely pro ETF person, and I think there are situations where direct indexing works better. And the other thing, and you guys can comment on this part of it, the other thing that I think is really important is a lot of people with direct indexing are being able to do more things than just harvest losses in the S&P 500. They're doing things to make their portfolio more of what they want it to be. And I think people are much more likely to stick with a portfolio over time when they've played a role in constructing it and they've expressed their values or their beliefs about investing or whatever it is. And so that if you put it in my spreadsheet might not make sense, but I think that is a benefit for direct indexing is this ability, we're customizing everything in our lives these days. The ability to customize my portfolio might make me more likely to stick with it over time. And that'll offset anything I could find in my spreadsheet against it.
There's an interview coming out in a couple of weeks. We talked to her on the P&L for a purpose thing. Perth Tolles has a way of calling this. It's portfolio construction is always some form of an expression. And I think I like that word because I like expression, how it connects back to what you're doing and what you're going to stick to. And direct indexing, to the degree that it's a direct expression of your views or whatever else, can be a really useful tool. It can be very tax efficient. It might cost a little more than the ETF, but it might actually accomplish some greater things. And on a tax adjusted basis, it might be better. All this stuff. These choices of expression, whether it's direct indexing, whether it's an ETF, whether it's even a mutual fund to express the choice, maybe it's even an interval fund, maybe it's a private equity fund. Like these are all choices that a person gets to make to express their stuff. The real important piece of this is that you did something you can stick to. And number one, you don't have a bunch of bad ideas, in which case you don't want to be proven out that like your rules-based system was idiotic. That's not a dig at value investors for way too long, but it is a dig at just the idea of like, you got to temper it against yourself. Don't be your own worst enemy. We have all these options and now we can make some really important and intelligent decisions with good options. 25 years ago, this was not really an option. And that's also pretty darn exciting. That's pretty cool.
The two areas that it has really opened the door for, one is actually somebody that we started the conversation with was a former Google employee who had just probably 40% of their assets tied up in Google stock. Right? We can't exit that position from a tax perspective without incurring big gains, and they're in California, like, Jack just went through that. The direct indexing strategy is a way for us to stay away from Google with the rest of their assets and continue to build on that. Now, we're obviously probably going to always be trying to sell some of that Google stock down because if something were to happen to Google, I don't foresee that happening, but it would be a major impact on their portfolio. The other one is probably what, is what you guys were referring to is around ESG and, environmental social governance, is if somebody feels like, hey, I don't want any casinos or I don't want any, cigarette companies in my portfolio. I don't, there's a way for somebody to express that in their portfolio. That direct indexing offers that without that construct, it is very challenging to go out to the market and buy individual securities. And the headache to do it, it's hard to justify. So, but the ETF way is, sorry, go ahead, Matt.
No. Or a manager who expresses your values. This is always the hardest part about ESG in that whole space is you have managers who are doing it in a way that they think they can sell. Right. Nothing wrong with that. We need managers to do it. But if the manager is not your exact expression, it was basically build it yourself or go home. Direct indexing has created a cottage industry around, you actually can kind of build it yourself around that expression. And so long as it's intelligently done, more power to you. You got tools to do this stuff. It's awesome. Similarly, just like managing around the concentration risk of like a Google, you could manage around the concentration avoidance. Like I don't want any tobacco or gambling, or I've got a specific thing about pharmaceuticals or something. That's again, powerful tool, did not exist a handful of years ago.
I was just listening to an interview Barry Ritholtz did with Jim O'Shaughnessy, and he was talking about this because they had worked with like a bunch of religious organizations, and like every one of them had a different definition of ESG. And so that's kind of what they were doing with Canvas is they built it so you could customize it to your exact thing. Because like you said, ESG is different in the eyes of every single person, or for the most part. I mean, most people have different definitions of it. So the idea that I can express that exactly the way I want to in my portfolio may not, on my long-term spreadsheet, may not say it adds to your returns, but I think it certainly adds to your ability to stick with your portfolio over time.
Yeah. And an equity portfolio, that stick-to-itiveness is massively important because this is it's just fraught with complexity. Like investing is fraught with complexity. Being human is fraught with complexity. But having ways to just continuously revisit the conversation and prioritize what matters, that's the name of the game. That's why we could do we could do an episode with 10 questions and turn around and we got 30 more questions in the queue. It's amazing. And none of us are doing this alone. It's amazing.
And that's probably a good note to wrap up on. And I promise we will not, hopefully people have enjoyed this and got value out of it. We will go back to our normal episodes next week. I will be droning on about value investing. Matt will be telling us how it relates to the work of James Taylor. And we will get back to our usual format, but I like doing these because I don't even know the answers to these when we come in. Like I said in the last episode, I like thinking through these things. Like the idea of the person that has the $5 million in a taxable account, like it's interesting to think through that because there's so many different levels below that in terms of how you think about that in the real world. So I think it's helpful for me just to do this, even if, nobody wants to watch it, but hopefully people do.
I've seen fund structures and I've seen pain. That's all I've got to say about that.
Well, thank you everybody for joining us, and we'll see you next week.
Hi guys, this is Justin again. Thanks so much for tuning into this episode. You can follow Jack on Twitter at @PracticalQuant. You can follow me on Twitter at JJCarbonneau, and follow Matt on Twitter at @CultishCreative. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. Also, if you have any ideas for topics you'd like us to cover in the future, please email us at excessreturnspod@gmail.com. We would like this to be a listener-driven podcast and would appreciate any suggestions. Thank you.